In this video you are going to learn the difference between account payable and account receivable. Let's start the video. In accounting, we often get confused between account payable and accounts receivable. So it is important to differentiate between accounts payable versus accounts receivable, because one of them is a liability account, and the other is an asset account. Mixing up these two can cause a lack of balance in your accounting equation, which carries over into your basic financial statements. What are accounts payable? Accounts payable are current liability accounts that keep track of money that you owe to any third party. The third parties can be banks, companies, or even someone from who you borrowed money. One common example of accounts payable is purchases made for goods or services from other companies. Depending on the terms of repayment, the amounts are typically due immediately or within a short period. Now come to, what are accounts receivable? Accounts receivable is a current asset account that keeps track of money that third parties owe to you. Again, these third parties can be banks, companies, or even people who borrowed money from you. One common example is the amount owed to you for goods sold, or services your company provides to generate revenue. Accounts payable leads to a decrease in cash flow, while accounts receivables lead to an increase in cash flow. Accounts payable is simply the total cost of purchases, whereas accounts receivables are determined as total sales, minus returns and all the allowances and the discount given to the customers. For account payables, the accountability lies on the business, while for accounts receivable, accountability lies on debtors. An increase in accounts payable represents a cash inflow from the delayed payments to suppliers or vendors, whereas a decrease in accounts payable reflects an outflow of cash, as the outstanding credit balance of customers is paid off in cash payments. On the other hand, an increase in accounts receivable represents a cash outflow, because more customers have paid on credit, so there is less cash on hand for the company. Whereas a decrease in accounts receivable reflects an inflow of cash, as more cash was collected from sales that were previously paid for on credit. If you want to read in details and download the PDF, go through the link in the description. If you find the video helpful, give us a like, share the video, and don't forget to subscribe to Education Leaves.